For decades, economists have repeated a powerful phrase to explain North America's economic reality: when the United States sneezes, Canada catches a cold. This idea is not political rhetoric, it is grounded in hard economic data, decades of trade flows, and repeated historical shocks that show how deeply Canada's economy is tied to its southern neighbor. The roots of this relationship lie in scale and dependence. The United States, with a GDP exceeding $26 trillion, is the world's largest consumer market. Canada, with a GDP of roughly $2.2 trillion, has built its prosperity by integrating tightly with that market. Even in late 2025, more than 70% of Canadian goods exports still flow to the United States, despite aggressive diversification efforts. By contrast, only about 15 to 18% of U.S. exports go to Canada. This imbalance explains why economic shocks in the U.S. transmit northward with amplified force. History repeatedly confirms this pattern. During the 2008 global financial crisis, U.S. consumer demand collapsed. As American factories slowed and imports fell, Canadian exports followed. Canada's GDP contracted by 3.3%, one of the sharpest downturns in its modern history. As the Bank of Canada later noted, external demand shocks from the United States remain one of the most powerful drivers of Canadian business cycles. That statement remains relevant today. The same dynamic appeared again during the 2020 COVID-19 recession. Although both economies shut down simultaneously, Canada's recovery lagged behind the U.S. rebound. American stimulus revived demand faster, and Canada's export-heavy sectors waited for U.S. consumers to return. These episodes cemented the idea that Canada does not move independently when the U.S. economy stumbles. The year 2025 became the most severe test of this relationship in decades. Instead of a financial crash or a pandemic, the shock came from policy. The United States imposed a series of tariffs, starting at 25%, and rising to 35% on non-USMCA compliant goods, framed around trade imbalances, border security, and broader geopolitical concerns. This policy shock functioned like a sudden economic sneeze. The immediate response from Canadian firms was defensive. In early Q1 2025, exporters rushed shipments across the border before higher tariffs fully took effect. This created a temporary surge in trade volumes. But the relief was short-lived. By mid-year, Canadian exports to the U.S. had fallen by more than 26% from January peaks, according to Statistics Canada. Investment stalled. Orders were delayed. Uncertainty spread across manufacturing hubs. The macroeconomic impact was swift. Canada's GDP growth slowed sharply, and Q2 2025 recorded a contraction. Industries most exposed to the U.S. market, autos, steel, aluminum, and lumber, experienced layoffs and plant slowdowns. Inflation ticked upward as imported inputs became more expensive, but the dominant force was weaker growth rather than overheating demand. In internal assessments, the Bank of Canada warned that a prolonged tariff regime could reduce national output by 2 to 2.6% and push unemployment above 8%. These were not speculative fears, they were scenario-based projections grounded in past trade disruptions. As one RBC Economics report stated, Canada's trade exposure makes it significantly more sensitive to U.S. policy-driven slowdowns than almost any other advanced economy. Yet by late 2025, the worst-case scenario did not fully materialize. Annual growth stabilized near 1.7%, and Q3 rebounded at an annualized 2.6%, supported by strong energy exports and domestic consumption. Canada avoided a technical recession, but per capita GDP remained weak, an important signal that the average household still felt the pressure. Why did Canada still catch a cold, even after adapting? The answer lies in structural vulnerabilities that tariffs alone cannot undo. Geography is the first factor. The 8,891-kilometer shared border enables just-in-time supply chains that cannot be replicated with overseas partners. Automotive manufacturing illustrates this perfectly. A single vehicle assembled in Ontario may contain parts that cross the border 7 to 8 times before completion. No trade agreement with Asia or Europe can replace that proximity. Energy integration is another constraint. Canada supplies over 60% of U.S. crude oil imports, primarily through pipelines designed specifically for American refineries. Redirecting that oil to other markets requires infrastructure that takes years, sometimes decades, to build. As the U.S. Energy Information Administration has noted, North American energy trade is shaped as much by infrastructure as by policy. The USMCA softened the blow but did not eliminate uncertainty. By August 2025, more than 95% of Canadian exports qualified as USMCA compliant and entered the U.S. duty-free. However, compliance costs rose, and sectors that fell outside the rules, particularly segments of steel and aluminum, continued to face punitive tariffs. More importantly, investment decisions were delayed because firms could not predict future policy stability. The transmission mechanism extends beyond tariffs themselves. If the U.S. economy slows due to higher consumer prices, disrupted supply chains, or reduced investment, Canadian exporters feel the impact almost immediately. Multiple studies show that Canada's GDP is roughly twice as sensitive to U.S. economic shocks as the reverse. This asymmetry remains the core reason the old saying persists. At the same time, 2025 also revealed signs of resilience. The Canadian government deployed over $6 billion in targeted support for exporters, supply chain financing, and affected workers. Counter-tariffs were structured to maximize political pressure in U.S. border states while limiting domestic inflation. Non-U.S. exports increased modestly, particularly to the European Union and parts of Asia, under agreements such as CETA and CPTPP. Political leadership also emphasized adaptation. Under Mark Carney, economic policy messaging shifted toward long-term resilience, internal trade reform, infrastructure investment, and gradual diversification. Public opinion hardened in favor of reducing reliance on a single market, reflecting a broader strategic shift rather than short-term panic. Still, experts remain cautious. As Brookings Institution analysts observed in 2025, diversification can reduce vulnerability at the margin, but geography and integration mean Canada will remain economically synchronized with the United States for the foreseeable future. Full immunity is not a near-term option. It is a multi-decade project. By December 2025, the evidence points to a nuanced truth. Yes, when the United States experiences a policy shock or economic slowdown, Canada still catches a cold, and often a harsher one. The tariff episode confirmed how quickly growth, jobs, and investment respond to U.S. decisions. But it also showed that the damage is not one-sided. U.S. consumers faced higher prices, manufacturers saw disruptions, and inflationary pressure rose south of the border as well. The relationship has not broken, it has evolved. Interdependence remains deep, but adaptation has begun. The old saying still holds, but its meaning has shifted. The modern reality is not about helpless dependence, it is about managing unavoidable integration in a more volatile world.